Good morning, everyone. Welcome to our Wednesday webinar series of Retirement Roadblock. And folks, this is our final presentation, but it's the beginning. You know, it's like a commencement. Commencement means beginning. So Brandon's going to take you through the entire presentation. But after this, we're going to take a rest break next week. Then we're going to get right back into retirement roadblocks and, make it more educational for you, and just to simplify it for you a little more. So here, we always wait a couple of minutes for folks to chime in. But what we will do, we're going to go ahead and get started now. So Brandon, take it away, my friend.
Awesome. Hey, thank you, Bernard. I always appreciate the opportunity to be on here. Thank you to those of you joining us and those of you who are going to follow up and watch on the IAD YouTube channel. Bernard said it right on. We're going back to the beginning. So what we're going to do is we're going to walk through our original presentation that is client approved and available for use for you right now as part of working with IAD to simplify your success. So this may go a little longer than kind of our standard half hour, but not too much longer. But what I'm going to do is I'm going to show you how to present the retirement roadblocks using this presentation and as if you were the clients, how you could do it in a webinar. You won't be able to do it live from basically in a room or in a dinner area for you, but here's how a webinar could work with this. And remember, it's the Retirement Roadblocks platform. We've been going over it now 2+ months, and it's all encompassing to help you have some of these conversations to not necessarily drive towards a product, but just to have the conversation around what are some concerns that clients may have in retirement, what are they not thinking of, and how do you basically plant that seed that this is something that you should be discussing or thinking about as they move into retirement. Couple of things before we begin, there are resources available right now for you to basically kickstart this process. If you look left to right, we've got a customizable invite already created. You add in your information. We've got one for a live dinner event. We've got one for a webinar where you're able to put your information, the time, customize it, pre-written, send it out to your clients or any prospects that you think might be interested in joining to take a look at this. Already done for you. We have, and I know IAD also has, quick start guides on seminars. There's one that's pictured here. I know Bernard and his team has seminar best practices. It's there, it's out there for you to leverage to say, hey, it's maybe been a little while since I've done some live events, or I'm trying to figure out a tip or two to really maximize my return on my time. The Quick Start Guide is going to have some great tips in there for you. Also in there is an event questionnaire. One of the biggest things that I try to help advisors and agents work on is how do we create action during a seminar or during an event? Yes, it's great to have information. It's great to network and see your clients and your prospects face to face and outside of the office. But how do you then drive action so that you can, again, capitalize on your time? This event questionnaire allows folks to essentially take a inventory of where they're at. Are they thinking about these things? How confident are they that they've covered all of their risks? And if there's some doubt there, when is a good time to schedule? As you work with Bernard or your IAD marketer, and as you think about these events, reach out to us. I have some really good ideas that actually, for one of the advisors I work with, he held 2 seminars and ended up getting 12 requests for follow-up from those 2 seminars. 12 appointments. He had, I think, 18 folks actually attend between the 2. And if you look at those numbers, if you get 66% of folks to say, hey, I want to go ahead and set up time, that's huge. And there's a few tips, some simple best practices that you can use to get close to those kind of numbers. And I'll share those with you. Bernard can share those with you, and how to leverage these questionnaires really easily. For those of you, and I know this isn't all, but for those of you that may have a registered rep on your resume, or you may have FINRA oversight. We have a FINRA approval letter already with this document. So if you need that to go ahead and share with your compliance team to say, look, this has been approved, here it is, this can really help the process go easily and smoothly if you need to get those types of approvals. It's all out there already for you to download and take a look at right now. One thing I think is important to share with you is I'm going to pull the screen back a little bit, show you behind the curtain. As you look at this presentation, what you're going to see is what the clients would see. But behind the screen, behind the scenes, this is written. As you can see here, there are presenter notes written for this whole thing. So if you're thinking, wow, the slides look good, but what am I going to say? How do I know how to do this? I'm getting into it. It's all written. All you need to do is take a look at the slides, take a look at what's been written for you, and customize it into your voice. So it's the way you want to present it, the way you want to be in front of your clients or your prospects. Again, already done for you. This is literally pick it up, implement it. It is plug and play. So now we're going to transition. Let's dive in to the retirement roadblock presentation. Again, you've got your customizable screen there. If you look, it's got my info, my title. You're able to add your company name. You're able to add your telephone number. All of your stuff can go in there as you move forward. Another piece of customization is your opening slide. Now that's obviously me on a much better day with better lighting and all dolled up, but you've got the opportunity to add your headshot, your title, and your qualifications. I didn't put any in there, but if you've got qualifications, if you've got, letters and certifications behind your name, add that stuff in there to help you stand out and really credentialize yourself. So let's dive into the retirement roadblocks. So I believe that an informed client is a better client. And to be honest, in my years of helping retirees and pre-retirees navigate the twists and turns of their retirement journey, I've found that there's a few risks that most retirees will face, if not all of these retirement roadblocks. And there are 7 of them that are going to be critical to your retirement. Because those roadblocks could potentially expose your retirement to unnecessary danger, I often refer to them as risks. The good news is the sooner that you're aware of these potential risks, the sooner that we can help you implement strategies to really help avoid them. So what are the 7 financial risks? Well, you see them here. We've got longevity, inflation, sequence of returns, withdrawal rate risk, Social Security risk, healthcare, and of course, taxes. The one certainty outside of, we're all going to die and we're all going to pay taxes, right? So on this slide, what I'd like you to do is go ahead and take a look at today's quiz. Before we start, I'd like you to just take a quick minute to inventory this for yourself. I've given you a blue and a red pen. We're going to start with the blue pen. And before this presentation, I want you to go ahead and do an inventory there of the top part of that questionnaire, the Retirement Roadblocks questionnaire. Go ahead and see how you feel. At the end of this presentation, we're going to come back to this and see if anything's changed over the course of this time. And we'll come again back to this around at the end. But to help guide our retirement discussion today, I want to introduce you to siblings Bill and Jill. As we join Bill and Jill on their retirement journey, we're going to see them face and handle the 7 retirement roadblocks, sometimes successfully, sometimes unsuccessfully. But by watching this journey, you're going to be able to get an understanding of how it could affect you if we're not prepared for it. Again, that's why we're here. I can help you prepare, but it's good to know where you might have some gaps for these roadblocks. The very first financial risk that Bill and Jill are going to face on their retirement journey is longevity. I would argue longevity is perhaps the single most important risk facing retirees today. To illustrate the issue of longevity, I'm going to ask the group, how many of you have maybe heard of Thelma Sutcliffe? Now, in April of this year, April of 2021, Thelma Sutcliffe was confirmed to be the oldest living American in the United States. At 114 years young, Thelma could be found living out her retirement years actually in an assisted living home right now in Omaha, Nebraska. Still giving interviews to this day. She was recently interviewed in the news and is talking about some of her favorite things to do in the home. So she is still active, she is still with it, and still taking photos and giving interviews. What's fascinating though about the United States today is there are currently 92,000 Americans that are age 100 or over. It's actually expected that the number of folks in that range is going to double within the next 20 years to 190,000 Americans over the age of 100. So what does that mean? It means today that Americans are living longer than ever, resulting in a retirement that can last 25, 30, 40 years for some. So let's take a look at some stats. We know today that if we have a 65-year-old couple, there is a 50-50 chance for men to reach age 89 and for women to reach age 90. That means half of the 65-year-olds are going to live longer. In fact, 1 out of 4 is going to reach their mid-90s, and even further, 5% of them will live to age 100 or older. The reality is that we're living longer, and retirement for many of us could be much longer than we had ever really anticipated. My best guess is that Thelma never really contemplated the fact that she'd be retired for 40 or, even 50 years, which she attributes, by the way, to living a worry-free life. There's a tip. That is what her big live long advice was. Now, earlier, I mentioned that living longer is the single most important risk facing retirees. Well, why? And the reason is because living longer is a multiplier of all of the other retirement risks. The longer you live, the more likely market risk, inflation, healthcare, just to name a few, will impact your retirement. The longer you're there, the more chance that that could have an impact on your overall retirement. So let's take a look at the inflation side of it. If you're one of the many retirees on a fixed income, inflation or loss of purchasing power is one of the greatest risks to your retirement income and overall your retirement lifestyle. Inflation is simply an increase in the cost of goods and services over time, but because it can increase gradually, inflation can sometimes be a risk that goes unnoticed. Now, this year, we just had a 5% hike. So it's not going unnoticed this year, but in years previous, it certainly may have. In periods of high inflation like the mid 70s and the early 80s, consumers were painfully aware of the strain on their wallets. For example, back in 1979, inflation was 13.3%. During that time, a 30-year mortgage rate could be as high as 12.9%. The noticeable impact from inflation was unmistakable. We all know that high inflation is bad. We get that. But even modest rates of inflation can have a cumulative effect. Over the past 20 years, we've been experiencing an inflation rate relatively low in comparison to many other time periods, so it can potentially go unnoticed. As a result, it's still there, but it's compounding over time, just taking longer to eat away at your purchasing power. Keep in mind that the historical average is 3.7%. So while the recent 20-year average is only 2.1%, it's likely those rates will eventually move closer to the historical average, like what we just saw this year of 5%, which could continue to rise moving forward. And so when we look at retirement income, we need to find strategies that are designed to provide increasing income to help adjust the rising, or to help address the rising costs of inflation. So let's take a look at an example. If you had $50,000 a year in income today at a relatively modest 3% rate of inflation, your income will need to double in about 24 years. So think about that. Your $50,000 today needs to become $100,000 in 24 years. In periods of higher inflation, let's say 6%, closer to what this year was, your income now needs to double in only 12 years. That's half the time. So think about Thelma for a moment. Now, she's been in retirement much longer than 30 years. So even at a modest 3% inflation rate, her income had to double not just once, but maybe twice during her retirement to maintain that purchasing power. So whether it's high inflation or low inflation, the longer we live in retirement, the more important it becomes that we create strategies to help maintain purchasing power so we don't potentially deflate our ability to cruise through retirement. We often rely on our retirement assets to outpace inflation. However, we all know, if you've been watching the last few months, the markets are completely unpredictable. They go up, they go down, they go up, they go down. We have a big up right now. What might happen next? Who knows? Typically, market pullbacks will have a minor impact on retirement savings because savers can simply wait for the market to recover. If you don't need to use the money, you don't have to worry until the market has time to recover. However, when market pullbacks occur early in retirement, when you need that money, they can have a major impact on making it difficult for portfolios to bounce back and provide the needed income throughout retirement. We call this sequence of return risk, or simply sequence risk. What's really frustrating about this risk, though, is it's based solely on luck and what's happening in the marketplace when you retire. We know we can't control or perfectly predict the market, but the impact that it can have on a retirement nest egg can be significant. I'm going to show you an example right now that demonstrates timing in retirement is everything. So we're going to go back and let's take a look at Bill and Jill. Bill did well saving for retirement, and when he had reached retirement age in 1996, he had accumulated $1 million in total retirement assets. And what he did is he followed a broad market index fund, and upon the first year of retirement, withdrew 4%. That's a pretty standard piece of advice for folks moving into retirement. You may have heard of the 4% rule, which we're going to talk about soon, but using a broad index and withdrawing 4% is a pretty standard piece of advice. Now we'll take a look at Jill. She's 3 years younger than brother Bill, but she followed in Bill's footsteps. And when it came to her investment strategies, she also amassed $1 million in total retirement assets by following the broad market index fund and started her withdrawals at 4%. The only difference is as Bill retired in 1996, Jill retired in 1999, just 3 years later than her brother. So let's go back to Bill. He started withdrawing $40,000 a year, that 4%, and adjusted it 3% every year for inflation. By the end of 2019, his withdrawals totaled just over $1,370,000. His remaining account value increased over $2,100,000. He's looking great. He's got plenty of money in his funds. He's been withdrawing to maintain his lifestyle. Bill is not concerned. Like Thelma, he's living a life with few worries. But let's take a look at Jill. Now remember, Jill retired in 1999, but she continued to follow brother Bill's footsteps by withdrawing $40,000 a year, adjusted 3% for inflation. But by the end of 2019, her total withdrawals totaled just over $1,140,000, 3 years less than Bill, but her total account value was only $148,000 left. Jill has $1,960,000 less than her brother Bill. And the only difference was when she retired. It's hard to grasp, but how's this possible? I'll show you. So what happened? Well, Bill retired in 1996 and experienced 4 years of positive returns before weathering 2 bear markets. From 2000 to 2002 and 2007 to 2009, Bill simply had more time for his savings to grow before the negative returns hit. Jill, however, retired in 1999 and only had 1 year of positive returns before the first bear market. Jill fell victim to sequence risk. The only thing she did different was that she retired 3 years later, giving her a different sequence of market returns. As you can see, the effects of sequence of returns makes it really hard to plan for retirement. We can't predict what the markets are going to do or when. And due to this level of uncertainty, many people are looking for guarantees. If you want to take sequence of return risk exposure off the table, we have strategies that can help. If you're not comfortable with trying to perfectly time the market, let's have a conversation. We have ways we can help. Now, I mentioned that they had been doing 4% withdrawal rate, that 4% rule, if you will. Well, let's take a look at withdrawal rate risk and why the 4% rule might not be the way to go anymore. Because of market volatility, researchers back in the 90s started asking, how much money could someone safely pull out of their portfolio each year and still have that portfolio last throughout retirement? We call that the safe withdrawal rate. Now, in the 90s, a financial expert named William Bengen told us that based on historical data, 4% was a safe annual withdrawal rate. 30 years later, though, today's researchers tell us that the 4% rule is actually more like a 2.7% or even 1.9% rule, depending upon how retirement savings are invested. Now that's coming from Morningstar. That's not something we're making up. That's industry experts. But even if we went as high as a 3.2% rule, that means 20% of the time you could still run out of money. In other words, what they're telling us is that we need to withdraw significantly less from our retirement portfolios if we want them to generate income throughout retirement. I'll give you a personal story. I myself work with a financial advisor, my wife and I, and at our last meeting, what he told us is running the numbers based on our current savings, based on our goals, when we want to retire, what we want to do. We also have an 80% success rate. Now, for my wife, that left her feeling really good. Hey, that's great, 80%. But for me, I thought about it in a little different terms. Now, for me, running out of money in retirement is not an option, because by the time I'm, maybe in my 90s, I don't want to be broke and have to figure out, where am I going to get money from? I don't want to have to go back to work or rely on maybe my stepdaughter or other folks for help. So for me, having an 80% success rate is like, I relate it to getting on a plane. If I got on a plane and the pilot told me, Brandon, there's an 80% chance we're going to make it to where you're going, but a 20% chance we won't. Well, I'm not getting on that plane. I'm going to go and find a different plane where we've got a much higher rate of success. And when I put it in those terms, it makes more sense to why is that not necessarily a great outcome. We want to be certain. So if the recommended annual withdrawal rates today are nearly half of what they've been historically, moving from 4% to 1.9% safely, it means that your nest egg will now have need to double in size. So let me show you. To generate $40,000 a year in income, based on Bill and Jill, using a 4% withdrawal rate, you need $1 million saved. But at a 1.9%, you actually need over $2 million to generate the same level of income. While if you're talking to folks that are close to retirement or just retired, that can be some really sobering news. It can be scary, but there's good news on the other side. And the good news is that there's a lot of various financial and insurance strategies that can help create sustainable lifetime income, that can help guarantee a lifetime withdrawal rate higher than 1.9, higher than many times than 4%. So when we meet to discuss your unique financial factors, we can explore what the safe withdrawal rate might be for you and how we can make sure that it lasts for your lifetime. So speaking of lifetime income, though, we're going to transition into Social Security, which is one of the few sources of guaranteed lifetime income for many retirees. Because it is so vital, it is important to thoroughly understand your options to optimize your benefits. Determining how and when you're going to file for your benefits can be really quite complex. There are a surprising number of options to consider, and choices you make could have a significant impact on not just your retirement income, but your spouse's and any survivor's income as well. There are a few things to note. You can start receiving Social Security benefits as early as age 62. However, you are entitled to 100% of your benefits when you reach your full retirement age. What happens really frequently, though, is that people start their benefits before reaching full retirement age, which may not be the best option. The decision to begin benefits prior or after your full retirement age can permanently decrease or increase your benefits dramatically. Let's take a look again at Bill and Jill. Bill and Jill both have a full retirement age of 66 when they are entitled to their full benefit of $2,000 a month. If Bill were to retire and take Social Security benefits earlier, say at age 62, he's going to experience a 25% reduction in his benefit. So his $2,000 now goes to $1,500 a month. On the other hand, let's say Jill actually waits till age 70. She's going to receive what we call delayed retirement credits. And her check now is going to actually increase by 32%. So at age 70, she's going to receive $2,640 a month. Now that is a significant difference between the two of them. So to put it another way, due to Jill's retirement credits, her total lifetime benefit will amount to almost $130,000 more than bills. Since Social Security is most likely one of the few sources of guaranteed income for people, when we meet, we can explore your Social Security filing options so you can make a strong decision about when and how to file for your income benefits. We've gone through a lot of risks, and we've been talking about a lot of the roadblocks in retirement, but of all the risks that we've outlined, healthcare is probably the single most difficult to plan for, even above sequence of return risk. So what do I mean by that? Well, as we age, your out-of-pocket costs go up. As a result, a healthy 65-year-old couple can expect to spend just over $12,000 a year in annual out-of-pocket costs. But by age 85, that number will triple to just shy of $38,000. Why such an increase in these out-of-pocket costs? If you look at your retirement, you'll see that that has three distinct phases. We call these phases the go-go, slow-go, and no-go years. During the go-go years, you are retired, you're healthy, you're active, and you're living retirement to the fullest. Every day is Saturday. And on Saturday, that's the day when you go out and you go golfing, or you go fishing, or you go and you do things with friends and family. Every day now is Saturday. In your slow-go years, though, your activity begins to slow down and you make more visits to the doctor. In the no-go years, living independently can become a challenge. At each of these stages, your healthcare usage and costs go up. So remember Thelma Sutcliffe. So Thelma, 114 years old, living in Nebraska, she spent most of her later years in assisted living facility, dining with her friends as her husband passed away in the 70s and she had no children. But many families that have extended family, they opt to explore in-home care options due to the high cost of, well, long-term care. Research shows that nursing home costs are approximately $7,700 a month, and that assisted living facilities are about $3,600 a month. So if we look at the national median cost for a private room in a nursing home, it amounts to about $92,000 annually. Many of us don't plan for those healthcare costs, but the financial cost of not planning for this risk can be devastating. We have to plan for contingencies by exploring insurance solutions that can help offset the potential risk of healthcare expenses. Now, the last risk we're going to talk about is our good old friend, taxes. Taxation is one of those risks that we actually can plan for proactively. Robert Kiyosaki, author of the best-selling personal finance book, Rich Dad, Poor Dad, said, "It's not how much you earn that's important, it's how much you keep that matters." Now, taxation speaks directly to that. So as we look at it, how many of you have IRAs and 401ks as your largest retirement savings? When you withdraw those assets, Uncle Sam is still going to want his cut. So while we may have a $1 million in a 401k, that's going to be significantly less after we pay Uncle Sam. The issue with taxation is that the future of tax rates is uncertain. The reason, well, in the fall of 2020, we had about $27 trillion in debt in the United States. And each year, the federal government spends about $574 billion just to pay the interest on that. Today, taxes are at still relatively low rates, but in order to balance the budget, there are only two options: decrease spending or increase taxes. If you think about it, how many people are going to believe that the government is going to spend less? Considering in the past 60 years, federal spending has only gone down 4 times. On that, it appears more likely that taxes will increase more so than spending decreases. So if the government were to increase taxes, we want to ensure that we have different sources of retirement income so that we can pivot should tax rates change. We call that tax allocation. There's 3 big allocations in your life: asset allocation, tax allocation, and finally income allocation in retirement. Tax allocation looks at taxable, tax-free, and tax-deferred savings vehicles. Tax allocation is important because it can give you the flexibility depending upon whether we're in periods of higher tax rate or lower tax rate. You can adjust how you take your income. For example, if tax rates go up and most of our retirement assets are in tax-deferred traditional 401ks or IRAs, that means that once withdrawn, our after-tax income is going to be less because tax rates are higher. But with that tax allocation, if tax rates go up, you could pull income from other more tax efficient vehicles like a Roth IRA and life insurance. Those aren't affected by the changing tax rates. So with tax allocation, you can balance where you're taking your income. As I mentioned, all of the risks, taxation risk is the one that we can really plan for proactively and start planning for as soon as you start saving. When we meet, we can determine if you're taking advantage of tax efficient vehicles in your retirement planning strategies to plan for whatever the future might hold. So today we've discussed the 7 major roadblocks or financial risks to avoid in retirement. In any retirement journey, the key is to not try going it alone. As a financial professional, I help clients navigate financial risks every single day. I can help you build a retirement income strategy to address each of these financial risks that we've discussed today, whether it includes addressing potential changes in taxation, optimizing Social Security benefits, or reviewing ways to address market volatility. My goal is to help you build a retirement strategy built on your time horizon, income goals, and risk tolerance. Last, but certainly not least, remember, Thelma could experience a 50+ year retirement. That's a really good reminder that retirement is a long-term prospect. We must keep a long-term perspective as well. A trusted financial professional can help you keep your emotions in check and not fall victim to the latest news cycle. I'm here to help you keep your eye on the ball and help you navigate these 7 retirement roadblocks. Now that we've gone through all of the material, let's go back to that quiz. I want you to grab the red pen and I want you to walk through these simple yes or no questions to see if anything's changed for you. Now, if you said no to even one of those questions, it makes a lot of sense for us to visit face-to-face to give you clarity about the questions you may have. And as you know, it never hurts to get a second opinion. So that closes us up on the Retirement Roadblocks presentation. I appreciate your time today. I'm looking forward to having the opportunity to work with each of you to help avoid potential financial risks and enjoy a more scenic route on your retirement journey. And that's the presentation, folks. That is me stepping now out of the advisor side of things. And that's it. 39 minutes, leaves some time for Q&A, leaves you time to have a meal if you had that planned in there, and also to mull around and start talking to people, see if they have questions or ideas or thoughts right away. Now, again, I've mentioned it before, but IAD, Bernard, your marketers have put together a suite of resources to support you. And we can help end to end. whether it's setting up a time with myself and Bernard to say, let's look at what exists. Walk me through this stuff slowly. Happy to do that. Or maybe it's a case and you want to say, hey, this is a client that's interested or could be a good fit. How would this work for them? We can walk you through all of that and help you every step of the way through. All you got to do, reach out to Bernard. His number, his info is there, and have a conversation. He can handle the rest and make sure you get what you need. So as he mentioned, we've been doing these every week. Now this week is the last one. We're going to take a break next week, and we'll be back actually in August to go back through some more content. Bernard and I are going to put our heads together and figure out what resonates, what's the great content that you folks are going to want. So if you have any suggestions or you have a question on, hey, I'm still unsure, I still am concerned, or I don't quite get, shoot it to Bernard and we can help tailor these every single Wednesday for you moving forward. So with that, again, I appreciate everyone's attention. I appreciate your time, and I'm going to turn it right back over to Bernard. To you, sir.
All right. Well, thank you, Brandon. Now, folks, this is the presentation in a nutshell. And I mean, the Retirement Roadblocks is a platform that works. Like I said, I practiced on my father, I practiced on his friends, and they gave me, you know, the older guys, they were like, but they enjoyed it. And they know they're going through every single one of those roadblocks. And we just have to build our confidence up, get it out before the clients. Like I said, that's what I'm here for. That's what Brandon's here for. Help you build that confidence up, help you present retirement roadblocks. And I mean, if you get to sell, you get to sell. If you don't, you don't. But as long as you present it to your clients, because this is exactly what they're going through. Perfect time now, right before AEP, because October 15th, I know you won't be able to sell annuities, but we can set the stage now. Start with the retirement roadblocks. This is what you're going to go through in retirement. And then when October 15th comes, you can start, you know, sell that Medicare Advantage plan. The whole goal is to get you to offer it to your clients as opposed to someone else offering, because they're not going to do the justice that you're going to do by offering, showing them the retirement roadblocks. So again, folks, thank you for joining this week. Like I say, next week, we're going to give everybody a little rest break. And then the following week, like I say, Brandon, we're going to put our heads together. And the following week, we're going to come up with the still retirement roadblocks, but we're going to come up with a different strategy. So folks, enjoy the rest of your week and take care. Bye.